reported earnings on November 15th after the market close. Implied volatility tends to spike before an earnings announcement, especially in the front-month options, due to uncertainty. After the announcement is absorbed by the market, implied volatility tends to go away in what's called a volatility crush. My goal was to try to profit from the change in volatility by selling an Iron Condor for a credit and buying the spread back when it's worth a lot less, pocketing the difference after fees. When I looked at the expirations on the trade tab, I saw that the implied volatility for all contracts for the 17 November 2023 expiration was 60.86%. This was about 24 percentage points above the next expiration at 36%, which signals that extrinsic value for these options was very high. After the announcement, that volatility should return to a normal range that's closer to the 24 November 2023s. The next step was to select my strikes for the Iron Condor. It's made up of 4 different strikes, a long and a short call, and a long and a short put of the same expiration. Another way to think of it is that you have a vertical call spread and a vertical put spread at the same time. Because an Iron Condor is made up of 4 contracts, paying a fee for each contract in each leg of the strategy could be considerable. Consider these fees as you set up and close your trades. I can earn max profit if the price of the stock stays in the upper flat area. This line is between the 2 short options. Profits decline and losses start if the price of the stock is below or above the short strike prices shown by this flat area. A large price move will put me not only outside of the flat area, but outside of the long strike prices, which is max loss. Remember that the short options drive the trade because of the credit from the larger premiums. If implied volatility falls, the value of the premiums will shrink. So if I buy back the options later, I'll get to keep more of the initial credit. Additionally, short options also benefit from time decay. Time decay may help me hang on to more of the cash received from the original credit from opening the trade. Of course, this only leads to a max gain if the underlying price stays between the short strikes. So once I've chosen my short options, it's time to select the long options. The long legs of the trade are farther out of the money because they're there to limit potential losses in case the trade goes badly. The further out of the money, the cheaper the options, but the higher the maximum potential loss. Another important risk to understand is if the stock price closes between the long and short strike prices at expiration. If that happens, I'll likely be assigned on a short strike. If it's the call, I'll need to deliver 100 shares of stock, which would put me in an unanticipated short position. The long call won't help because it'll have expired worthless. That makes me subject to unlimited risk if the stock rallies. If the short put is assigned, then I may end up owning the shares, which could also fall in value. I've talked a lot about selecting the strikes, so let me explain how I did it. I used the expirations implied volatility to help me because it provides an idea of how much the market thinks the stock is going to rise or fall after the announcement. In this case, it's plus or minus $2.40. The tool doesn't give a direction, just an idea of how much a move is reflected in the price of the options. If I only use this tool, I will want my short call at least $2.40 higher than the current price, and the short put would be at least $2.40 lower. However, there are 2 other estimates of a price move traders often consider. First is the market maker move, which is only available on the Thinkorswim platform. It shows up about a week ahead of an earnings announcement and uses several factors, like implied volatility, to estimate how much the market expects the price will move after the announcement. In this case, it was forecasting $2.33 in either direction. The second tool is the at-the-money straddle for the front month. I saw this by changing the spread to straddle. The 53 straddle had a mid price, which is the halfway point between the bid and ask, of about $2.42. So these tools gave me a range of $2.33 to $2.42. With Cisco now trading at $53, I thought about putting the short call strike at 55.5 or higher and the short put strike at 50.5 or lower. However, I also wanted to look at the chart for some additional insight. The 90-day 1-hour chart for Cisco showed the stock was mostly moving sideways and implied volatility was near its high for the period. Despite the rise in volatility over the last month, it moved down a little the previous week or so. Ideally, I would have liked a spike in implied volatility in anticipation of earnings the next day. Looking at the stock price, I could see some consolidation between $55 and $51. I drew some lines to mark the area, which were in line with the other tools. So, I started the Iron Condor trade using the Trade tab, changing the spread layout to Iron Condor. Then I selected an Iron Condor that was close to the strikes I wanted, knowing I would finish setting the strikes in the Analyze tab. Then I changed the number of spreads to just one. On the Analyze tab, I set the call strikes at 55 and 56, and the put strikes at 50 and 49. Both levels were near my consolidation lines and outside the Trade tab tool's averages. My hope was that the stock would stay between these levels. So, the theoretical max profit is about $35, which I'd get if the stock price stays between the short strikes at $50 and $55. But I do have some extra space between the strikes to eke out some smaller gains, as well as break-even points too. These spaces slightly increase my likelihood of getting some profit. The theoretical max loss is about $65, which occurs if the stock price falls below $49 or goes above $56. When trading in Iron Condor, I'm weighing the reward, the risk, and the probability of success. Currently, I'm risking more than the potential reward. However, the price can rise or fall $3 in either direction, and I could still make some profit, which I believe is a pretty good probability of success. Every trader must determine what numbers they're most comfortable with. I went ahead and placed the trade. The next stock was Copa Holdings. It reported earnings the same day as Cisco. The 17 November 2023 implied volatility was at 89.4% and was forecasting a move of about $6. The market maker move was a little lower at $5.78, and the at-the-money straddle mid-price was $5.65. The price of the stock when I was looking at this trade was $91, so I could have placed a short call strike at $97 or above and the put strike at $85 or below. Next, I analyzed the chart for Copa to see the support and resistance areas. Implied volatility was higher compared to historical levels, but off its highs. I typically prefer to see it spiking higher, but I felt that there was enough room for the trade to work. I drew a line around $96, which was tighter than the other tools indicated. The other line was at $76, which was well below the other tools. Moving over to the Analyze tab, I could see that unlike Cisco, which had more strikes to choose from, Copa had strikes at $5 increments. So, this Iron Condor ended up a bit wider with the call strikes at 100 and 105, and the put strikes at 80 and 75. The theoretical max gain was about $35, which could be achieved if the stock's price stayed between $80 and $100. The theoretical max loss was about $450 and occurred if the stock's price fell below $75 or spiked above $105. The risk to reward is quite large, but I do have a range of $20 for the stock to stay within, so the probability of success is relatively high. I went ahead and entered the order. The final trade was Sociedad Química, which also was reporting earnings on the 15th. The 17 November 2023 expiration showed implied volatility at 96.8%, with an estimated move of $3.71. The market maker move estimated the move at $3.29, and the at-the-money straddle mid-price was at $3.65. So, with the stock near $51.40, the short call could have been around $55 and the short put near $47.50. I compared this to the chart where the implied volatility was high without a big pullback like the other two stocks. I drew lines near $56 and $45, which was wider than the Trade tab tools. Moving to the Analyze tab, I set the call spread to 55 and 57.5. The put spread was at 47.5 and 45. This gave me a potential max gain of $65 if the stock stayed between $47.50 and $55, and a potential max loss of $180 if the stock fell below $45 or shot up past $57.50. Because these were very short-term trades, my only planned exit was to close them after the earnings announcements. Remember, the lower the closing premium, the better. If the value goes higher, then I'd have to pay more money to close the trades for a loss. I wouldn't want to let them expire because the short options may be assigned, leaving me owning or shorting 100 shares of the stock that I may not want. And we're back. All three stocks reported earnings after yesterday's close. The Monitor tab shows that I'm down on 2 of the 3 trades. Let's break down what happened. First is Copa. It had a profit of $20.50. From the Analyze tab, I can see that the stock price stayed between the strike prices. The space between the pink and the blue risk profiles shows that there's still some extrinsic value that can melt throughout the day, which would make the trade more profitable. Next, I'll look at the chart. The stock price has moved higher and implied volatility has fallen. In this case, I was able to capture that implied volatility crush. So, this trade went pretty well, but I need to decide when to close it. The options don't expire until tomorrow, so I could wait one more day and use time decay to get a little more out of it. The trade-off is gamma risk. This means that a price move in the underlying stock could result in a big move in the options contracts, which could turn my profit into a loss. It's a risk I don't think is worth taking, so I'll close the position. The next on the list is Cisco, with a loss of $64.50. I'll take it to the Analyze tab too. The price of the stock has fallen into max loss range. Notice that the pink risk profile is above the blue one down here. This indicates that time value is now working against me. So opposite of Copa, I don't want to let that last little bit of extrinsic value melt away when I can salvage some cash from it. I could hold on to the trade and hope the stock will bounce back. The chart of the stock shows the price has fallen, and so did implied volatility, but the price offset the gains from the volatility crush. It's hard to know what the stock's price is going to do next, so I'll enter the closing order. Finally, there's Sociedad Química. When I first logged in, it showed a small loss of $2.50. However, a minute ago, it showed a gain of $2.50. Now it's at 0. The risk profile shows that stock price is below the max gain, but still above the break-even point. So if I was to wait, assuming the stock price didn't move, I could possibly walk away with a small gain, about $50 if all extrinsic value had melted away and not accounting for commissions and fees. The chart for SQM shows that the stock has fallen, but implied volatility may not have seen the entire volatility crush yet. So once again, I could try to hang on to the position and monitor it to see if time decay and falling volatility could make the trade more profitable. But when it comes to managing trades, you have to weigh the amount of potential gain to the time spent monitoring it and the risk of it turning into a loss. In this case, I don't think the small potential premium is worth it.